Be patient. There might be one or two questions ahead of yours, but as I mentioned, we will try to get through them all. We also encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience or what I've done in my personal account, but you have a different way of viewing a rollout opportunity, a management technique, or a trade entry, use the question pod as before and send that to us and we'll share it with the rest of the audience. There's a lot of terms out there and there's a lot of questions, there's a lot of structures that can be manipulated. So I may ask you for clarification on your question. It's just so that I can make sure we're looking at the same thing. In addition to that, most importantly, let's have fun. Let's get some good education under our belt and get ready for the weekend. Sam says, good afternoon to everyone in the room. Had a great payday today with the spreads. Been playing Tilray up and down. It's been a swing trade and it has been all over the place. Yes, Sam, it has. Ernie and I had multiple discussions about that. I haven't touched it. I don't think he got back in, but he called me one day and said, did you see it again? It's up to 170. And then 3 days later, it was back to 106, I believe. And then 2 days later, it's back to 115, 118. I didn't see where it closed today. That's been an interesting one that you've been talking about for about a month, as well as CGC, which had some good moves, but then had it look like an opposite move today. I wasn't really sure. In any case, let's get right into it. Once again, I encourage you to use the question pod to send us a question at any time during the webinar. Now we're going to start off with a question that was sent to me by Paul. Paul entered into a long collar on AMD several weeks ago. Okay, and he's concerned that he's not seeing the profit. He called it his worst long collar trade ever. I think he called it that, or most disappointing, perhaps, long collar trade. Well, the stock's up 11.38. He originally got in at 19.19, closed today at $30.88, so up a little bit more actually by the end of the day. And because of the adjustments of the collar and the rolling, he's only seeing a profit of $100. Now, when I refer to a long collar position, it's different than what you hear me discuss with the radioactive trading concepts. I use the collar position roughly, I'd say about 15 to 17% of my trading capital, so maybe only 1 or 2 positions open at a time. It's a protected income strategy, and I hate to use this term, but sometimes I use the term, it's sort of a fire and forget trade. Now, initially, as I mentioned, the stock was open at 19.19, and I think the first transaction was selling a 1950 call with a potential for 94 cents, excuse me, roughly. I was having trouble getting Paul's numbers down exactly. And of course, buying the 1850 put at the same time. And these were 30-day out. I believe they were for September 21st or September 14th. I'm sorry. I think they were for the September 14th expiration from the 6th. So it was about 30 days out in time. Now, this was on around August 6th when this trade was opened. I'm just going to use 100 shares of AMD as an example, 1919. Based on some of the numbers I saw, it looked around that it was the 5th of October, my apologies, 1950 call for about 94 cents, and the 5th of October 1850 put was bought for 76, about a 20-cent net credit. Maximum profit to the upside in 30 days is 2.6%. Maximum risk to the downside is 2.7%. Okay. Sam says 1950. How did he do that when the stock's around 30? This was from August 6th. It was a trade that this collar, Sam, was originally opened on August 6th, roughly, I believe. The stock has had an amazing run, had a great pop about September 5th, September 6th, maybe before then. All right. So this looks like a good standard one-to-one long collar that I would use in my personal account, meaning that usually what I look for a 25 to 30-day collar, long collar, meaning selling a call and buying a put, call slightly out of the money, put slightly out of the money, same expiration date. Not like a radioactive trade where I might buy a 6 or 7 month out put as I'm more bullish long-term on the position, and then I'll look to do adjustments shorter term as the stock fluctuates up and down in price. Okay? But between now and about September 12th, I believe, to where he is now, the position was rolled 4 times. What do I mean by that? He adjusted the short call and the long put, bought to close the short call and moved it up, sold to close the long put for whatever value was there, moved that up as well to continue to re-bracket the collar and try to follow the stock up. All right, Sam, so to better answer your question, we saw it close today at 30.88. I believe the current position is short a 29.50 call, long a 28.50 put, or a 28 put. I think it was 28.50. Okay. Now, we're going to look a little bit deeper into this, but not into this particular position. But what I want to talk about briefly is the concepts of rolling a collar, which is what Paul has asked for help with. Okay? In previous webinars, discussions that we've had, and as I just sort of mentioned, I consider the collar an income strategy, a standard long collar, an income strategy, roughly 25, 20 to 30 days out in time, maybe even 14 days out in time. And what do I mean by a fire and forget position? Well, I'm going to buy stock, I'm going to sell a call that's slightly out of the money. So let's say here's the stock price. I'm selling a call that's slightly out of the money. I am neutral to bullish on the position. And I'm going to buy this put, so in case there's the opposite effect of what we saw with AMD, if over the course of that 20 or 30-day period the stock dropped 6 points down to $13, I try to control risks to under 4%. And I'm looking for a return above 2.5%, really above 2.8% is kind of my average of what I look for with the standard collar positions. Okay, so that's just a rough estimate of the risk graph. Why do I do this with a smaller portion of my portfolio? Well, I like the strategy. It's worked out well for me over time, 11, 12 years of trading the collar strategy. I like the risk-reward concepts. It performed better for me over time than covered calls because of the protection. Now, I don't get the 2.8 average each time. That's an average. Sometimes it's only 1% if the stock is between the strike prices near expiration. And sometimes, yes, the stock exceeds my expectations and moves well above the short call strike price, and we talk about management. Now, when I say this is, to me, a fire and forget strategy, what I mean is I'll put it on for 20 days, 14 days, 28 days, whatever it is. Let's say average 20 days. If the stocks move above my short call strike price and it's doing what I want, I typically will not manage this collar. To match my trading plan, which comes out that I want to be right, or I'm averaging what I am, but with this portion of my portfolio, I'm looking for this to be right about 68% of the time with the average 2.8% gain. And this loss, I really only want to hit about 20% of the time, but I'm looking for about a 68% win ratio with this strategy. I've been able to exceed that over 10 years, so I keep doing this strategy. But other strategies I use in my portfolio outperform the return on this one. This does better for me for covered calls because when you have that sudden 10, 15, 12% drop even with a stop order, that throws the ratio out of whack completely. So if I can still get near the average return I'd want for a 20 to 25 day trade of a covered call with a little bit more speculation, and I control risk to this level and can still achieve that risk ratio, win-loss ratio, I'm doing very well. The reason why I bring this up is that the collar is a lot like a covered call. It does cap the gains. It does not leave the upside open as you would see with a married put with just a long call, with perhaps a bear call credit spread done on top of owning the stock, which you'd get less premium for, but it would leave the upside open. So as the stock moves up, you're forced to adjust the position. Now, if my original return was about 2.7%, if I was assigned, and I'm forced to roll it, well, this doesn't increase the expectations. Right? So you're originally out to about October 5th, which is over here somewhere. I'm sorry, which is not on the graph. I apologize. If you're originally out, I'm sorry, to September 14th, which probably would have been right around in here, I believe, okay? So as the stock moved up, you decided to roll the call. And even if you've rolled out, you have to remember, I think your first roll was done on 8/23, or that was the second roll was done on 8/23 perhaps. But on 8/23, going out 20 days from 8/23, going out further in time, you shouldn't expect an increase of any more than another 1 to 1.5%, even though the stock is moving up. Now, you might expect that AMD at the money covered call might give you about a 2% yield for a 30-day trade. That's fine. But remember, you're still buying this back for a hefty premium. A lot of it is intrinsic value once it goes above your 1950 strike. But you're paying a lot, and then the movement, you should only expect a 1 to 1.5% increase. Now I have to stop. Just like we talk about with managing the bull put credit spreads from last Wednesday, or just about how we talk about rolling even covered calls. If my goal is to make an average of 2.5% on the position for a 15, 20, 25-day trade, if I look to roll the short call up or roll the collar up, my new return, if I'm extending it 20 days further beyond the original expiration, should also be 2.5%. I have to stick with my trading plan. If I perform this adjustment, I look at a rollout opportunity on my collar, now that it's gone above my short call, and I think it's going to continue to run, if I want to stay in the collar format with the capped gain, this return should move from that original 2.6% you had to 5.2%. That new potential return if assigned should have been 5.2%. If it wasn't, I would not have rolled the position. I would have taken assignment, been happy that I got my goal, my target goal of 2.6% on the stock that was moving up. Because this is not designed to be a long-term strategy. This is designed to match a trading goals that you hope to make the maximum profit, 68, 75, 80% of the time, whatever your goals are realistically. I think 68 to 75% is realistic in a bull market. But when you keep trying to roll it to get extra profits, you're increasing the cost basis of the underlying. You're also increasing the cost basis by moving the put, and you're only probably averaging maybe 1 to 1.5% increase of the original expected return. You're losing ground by rolling up. It might be better to just take assignment, even leaving it open till September 14th. The first expiration cycle of the position, I believe. I think I've misstated that twice, and I do apologize for that. But taking assignment at that point, and then when you go in on Monday to open your new collars, that new portion of your portfolio, run your search, and if AMD comes in at a higher price, $24, $23, but the new collar that you're looking for is again offering you the 2.6% return that matches your trading plan with only 2.7% risk, open that position brand new. Yes, you're paying for a $20 stock now that was at 19, but you made your 2.6% to the upside that you were expecting. If the roll up with both the call and the put, oh, the comment came in, I have to clarify that. Someone said that, so you look to double the return. No, I misspoke that. I was saying in this example, if Paul's goals were for that first 30-day trade that he entered, the 30-day collar that he entered was to make a max 2.6% return. If that's his average goal, then the roll should have increased the profit. Rolling further out in time, rolling up in strikes, it should have taken the profit from 2.6 to 5.2. If your goal is to make 2%, then if the original position was a 2.6% max return, it went above and I felt I wanted to roll the collar, the entire collar up to keep that strategy, the new return would have had to have been 2% higher, 4.6%. Okay, has to match your trading plan. If your trading plan is a strategy, and we can relate this to covered calls, if you're selling an out of the money covered call, and your trading plan is every 15 days, every 20 days, you're looking to make, let's say, a 1.9 minimum % return if assigned within the money. If the stock exceeded your expectations, you want to roll it up to see higher profits. If rolling out another 15 to 20 days into higher strike prices doesn't increase your current return from 1.9 up to 3.8%, don't do the roll. It is not matching your trading plan. You're now trading against yourself. So in this case, the gains are capped, and as the stock runs up, you're kind of standing in the way of the freight train. You're trying to jump ahead of the freight train, for lack of a better term, you're never going to make that back. Okay, if the stock moves up 10%, a standard collar position, a standard covered call at or just out of the money is probably going to increase 2 to 3% at best. So you're not making that 10%. You're never going to catch up to that. Okay, you can keep rolling, you can keep rolling, you can increase your returns, you can keep matching your trading plan, but you're not going to catch up to it. Now, back to the fire and forget. If the stock ends up between the strike prices and my call expires worthless, my put expires worthless, then yes, I may re-bracket the collar. And if it falls, and I don't have any expectation of it recovering, I was just wrong on it, I may just take the loss and move on without managing it. This type of position, and someone brought up a point I'm going to get to immediately as well. We're going to take a look at the stock chart in a minute, but I'm going to take a look at that after a few other comments on the standard collar structure. But if it's above, very rarely will I continue to try to catch the gain by continuing to roll the short call. Eventually, I just want to take my return, get what I wanted on this position. If I re-enter it later, that's fine. I might have more capital invested because it's, 10 points higher, 8 points higher. That's okay because I'm trying to get collars in my portfolio that match my return, okay, that match my trading plan for that position. Okay. Another thought concept here is that this position was originally entered, as we mentioned, and the stock was bought at 1919, and it was sold, sold the 5th of October. Jeez, sorry, folks. 5th of October, 1950 call. Well, let's say the stock was trading at 23, and that's when we decided to roll the position and move the call up to the, actually it was about 21 or so, so we would have rolled the call up to the 24 call. It was around 23, and the 22 put. That was one of the first rolls from 1950, 1850 up to 24 call, 22 put. Let's say the stock was around 23. Now, if the stock exceeded my expectations and I wanted to stay into the trade, rather than re-bracket the collar, what I might have done is waited a little bit longer, and this was a long time away. This is out to the 5th of October. That's another point. You entered a 30-day trade, roughly. It's more than that, actually. It's almost a 45-day trade for the 5th of October, almost 60, actually. However, looking at it in that fashion, I would have waited longer, and if the stock continued to go up, I may have just waited to get assigned, sure, missed out a lot of opportunity, or I may have just bought back the call, sold to close the put, but then I may have bought a further output, left the stock where it was. I've increased my cost basis now based on the buyback cost of the short call, but then converted it to a married put with maybe a January or February or maybe a March put. So I still have a lower cost basis than where the stock is trading right now. I took in 20 cents premium. I was below $19 cost basis. The stock's at 23. I've got to pay a fair amount for this 1950 call. Okay, so maybe my cost basis is around $22.40, $22.50 on a stock trading at 23. Well, now I might be able to buy a 25 strike put out to March or January, which would have run me maybe for $5. But as the stock's at 30.88, that put that's out to March or February is still going to have a lot of the time value remaining. I still have a low risk on the trade, and I could decide to try to sell calls in between or just do other adjustments as well. Okay? Now, I'm not here to say you did the wrong trade. I'm saying that just like a covered call, although the collar strategy solves many problems that come with the covered call, because of the controlled risk on the trade, the guaranteed controlled risk even in the worst case scenario, and you can still get a good average return for a 20 or 30-day trade, it still has the same problem of the cap gain. And if the stock's up 5 points, you're going to have to pay 5 points to get out of this short call, your obligation, and you might get 40 or 50 cents for the at the money or just out of the money next strike. But then you're going to have to move the put as well. You're going to be adding into the cost basis of the underlying and for the new protection. That's why I see this as more as a fire and forget position. But if the stock really exceeds your expectations, convert it to a different strategy that gives you more upside, not a collar or a covered call that caps the gains. Okay? You extend the trade, that's true. And you're trying to get higher profit, that's true. But with the cost basis increasing on both the lower side and buying back the call, like I said, you need to make sure that that return, don't roll for the sake of rolling. Make sure that if you're rolling up a collar because you want to get higher profits, even if it's 5 days, 10 days after the trade was opened, make sure that whatever you're rolling to follows your trading plan. I don't want it to just increase my return by 0.8% or 0.5%. It has to increase it by my trading plan. And if my trading plan is looking at a 1.8% return every 14 days, if I buy back the initial collar and roll it 14 days out in time, I need it to increase from my expected max return of 2.6%. That needs to go up to 4.4% now. If it doesn't, if it's only a 1% gain or a 0.8% gain, there's no point in rolling it because you're now trading against your plan and your goals for the position. And you can say, oh, well, I'm missing upside if I don't continue to roll it. Again, this is part of the reason why we see an $1,100 increase on the stock and you're looking at only a profit of 100, 1/10 of that. This strategy, covered calls, collars, standard collars, even diagonal, or what we might call diagonal calendar spreads in a sense, but diagonal collars where the put's further out in time, you sold a short call. Once you sell that short call, you are capping the gain. If the stock has a large run, you're giving back to the market. There's nothing wrong with that. All right, it did meet your goals, but if you roll it, you have to make sure it matches your trading plan. Some of you saw it caught me on Ollie last week, OLLI. I had sold the September 90, and it had actually moved up and then pulled back, but I believe on Friday it was around 92, 93. So I had to buy back my 90 call and roll to the 95 for October. I'm still very happy with this because I increased the return by 2.5% from what I would have gotten on that radioactive trade with a short call in September. I increased the return by my goals if it's around 95 on October expiration, which, knock on wood, talk about catching the freight train, unfortunately the stock gapped up 160 or so today, and it's at 96.10 right now. So it was below at 94 yesterday. Now we're up above my 95 strike price, and I got to think about what I'm going to do next week. Okay, so I think collars are a strategy that are more designed to get assigned and make the maximum return to follow a trading plan, like many of you might be doing with covered calls. If it keeps exceeding your expectations, you want to try to convert the trade to something that more matches the direction of the stock itself. But at the same time, if this pulls back in the next week, I'm not saying it will, but if it pulls back to 24, you likely have a guaranteed profit to the downside, which I know isn't what you want. You want to say, hey, my stock went up $1,100. I should be making at least $700 or $800 of that. Well, when you're continually rolling with a covered call or a collar, you're not going to see that 50% of what the stock is doing. It's going to be much less. It's probably only going to be about a third of what the stock is doing. Okay. And again, if I hit my goals and made that 2.6% return, I may consider taking that profit, but then buying back the stock if it's still going up the way I want, converting it to a different position with a slightly lower cost basis from the return I had on the previous trade, again, as a long-term married put or radioactive trade. Okay. And Sam, let me go back to your comments here, starting from the beginning. Okay. Yeah, Sam talked about the bear call spread, that he's been leaving the selling a call and buying a call to leave the upside open. He's been making weekly. His cost basis on AMD is around 19. He owns 300 shares between 19 and 21. Okay. A management technique that might be discussed with the collars is adding the long call later. If the stock's exceeding, Sam says you could buy the long call, that's true, but if I do that in the collar because it's exceeding my expectations, the call I'm buying has to be less than the net premium I originally received. Because again, I'm not trying to swing trade a collar. in that case, Sam, of course, that's just my approach, all right? I'm not trying to swing trade the collar. It is for me a fire and forget trade. I'm hoping if I got assigned, I'd get that. And then Sam mentions about SYN, bought at 360, sold at around 7, then swung back into different puts on it as well. And it's down to 260, I'm sorry. Of course, oh, I'm sorry, crossover, Rhajiv's comment is next there. I'll get to that in just a second. Yeah, I'm sorry, SYN closed at 360. Okay, I see, you didn't trade it on the downward, Sam. I'm sorry, you didn't trade on the downward. SYN closed at 360 there, but you got out at about 7. Okay. All right, and we talked about that. Okay. All right. Okay, so I'm going to have more on this later. I know I still have to get the blog together for you guys about that. I'm halfway through it. I had to stop today for some other projects and other things that came up. But when we did that webinar last Wednesday on the 8 ways to manage the naked put, I have a follow-up blog that's almost done that shows how did those 8 perform to the 21st. And we're going to delve into the steps of long collar, in my opinion, standard long collar management techniques later next week, probably on Thursday. You'll see some more information on that. I'll get deeper into this, Paul. I didn't have the time to do that today. Now, Rhajiv's question is related to this, and then he jumps into another question. Okay, that's going to take me a while to follow there, Rhajiv. But in any case, Sam says, Rhajiv says, following up on this, says, good afternoon. Fundamentals look like it changed for AMD. Yeah, pulled back to the 20-day moving average. We'll take a look at that in a minute. And you say Intel may be a better option for a collar. Well, again, only if the premium's there to match the trading plan. And you said there's positive news for Intel. Okay, well, let's take a look. Let me pause the screen here. We're going to navigate over to PowerOptions. And what we're going to take a look at now on the PowerOptions tools, of course, is what I would look at to quickly see the trend lines of a stock that someone mentions to me during a webinar, coaching session, or phone call in relation to, can't give you advice on what I consider it good for, but we can look at the pros and the cons. So we know AMD has been on a tear. So it was the first thing I did, and we already saw part of it, the first thing I did when Paul sent his email today. Well, I looked at AMD, and I went to the quotes page. So I clicked the quotes link here up at the top bar. Now this takes me to the stock research page. I can see where the stock is trading now. I can see important data here. I can look at the technicals here, Bollinger Band ranges. MACD is listed here as well. The earnings per share growth, which is one of the reasons why this moved. The 1-year range, of course. We just bounced off the top of that, I believe, recently. But then what I always do, of course, is take a look at the chart. It's down big today. So we can, well, it's down decent. It's down 5% today. So we can say it's a good thing you still had the put in place for the collar, but that doesn't calm any of the nerves here about what happened. But I'll look at the stock chart, and sure enough, I agree with, based on my criteria, I agree with Rhajiv that we just had a negative MACD crossover. Again, I know that doesn't help Paul, but you are standing with that 29.50 call still open and the 28.50. Had a negative MACD crossover here. The MACD is now below the EMA. We're just touching, but not quite below the 20-day moving average. We're pulling off the upper Bollinger Band, and the RSI is declining. So we'll have to see what happens Monday, but this could continue to let up and continue to drop. Now, the argument from Rhajiv, or the comment from Rhajiv, is that Intel, he feels, is a better collar. And that's nothing fair. I'm not saying that necessarily. He says, okay, so here, recently we have the positive MACD crossover about 10 days ago, 8-9 days ago. Right? So the blue line's now above the red line. We have a positive MACD, but it's not above the divergence line. We've bounced to the lower Bollinger Band and then finally broke above the SMA 20. It was holding at it, but then bounced off it. And now we broke above it. RSI turning back positive around the mid-range. It was at about maybe 43, 44. Now it's jumped back up. It's crossed 50, and it's moving up. So these do look like positives, but I prefer to see this above the divergence line. and I'd prefer to see this up a next day above the 20-day moving average. But you're right, this one looks like it's going the direction of a neutral to bullish strategy more than AMD, which looks like it's turned the corner and looks like it's about to drop in that scenario. Well, it is dropping right now, but I can't say that it's going to keep doing that. That's speculation, but based on the charts, if I ran a chart for a collar, you're right, Rhajiv, this might come in. It's above the SMA 20. It's got a positive MACD within at least the last 3 days. I don't usually use the RSI moving up, but it is, oh, sorry folks, it is in those ranges there. But I'd like to see more of a trend above the divergence line. That doesn't always happen. It is kind of bouncing off the bottom here and moving up. I'll wait to see if it closes. I'd wait to see if it closes another way above the 20-day moving average. Okay. So on Monday, if it closed there, it's interesting that the Bollinger Bands are starting to condense a little bit. But again, I don't know when Intel's earnings are in that scenario. Now, so it's a tale of two charts, right? And AMD pulling back might actually benefit Paul's position if that short call to 29.50 expires worthless. He's out to, I had it down here in my notes here, but I forgot the expiration he's in now from his email. He may be as far out as October, standard expiration on October, maybe even the 26th, a week further out, I'm not sure. But if that expires, he doesn't have to worry about pulling it back if it's back near the 29.50 range. But it does look like it's pulling negative right now. Okay, but again, we could all see a pop on Monday, depending on what happens over the weekend and what news comes out as well. So is this a good transition for a collar? Well, I don't know. Okay, for a standard collar. It might come up in my search based on the fact that it's above the SMA 20, MACD is positive, RSI is moving up. It's in the mid-range of its Bollinger Bands, for example. I do agree with your assessment, Rhajiv. It does look better to me, but is it a good position for a standard long collar? Well, let me check. It's got to match my goals, too. Just because the stock chart matches doesn't mean for me it's a good trade. So I'm going to go to search by symbol, and we're going to look at INTC. And I'm going to take a look at the standard October. What did I say? 20, 25 days out, 14 days out. Let's go straight 21. Okay. I just want to see some standard collars. It shows me some conversions. Don't touch these. Don't touch the conversions there. So what I'm really looking for is at 47.29. I probably want a 48.45 spread if I can find it. There's 49.46. It's close. 3% return, 3.4% risk. That's not bad. What is my premium, though? Oh, that's a disaster. My net premium is only 12 cents. No, I couldn't do that one. All right, let's just go to the custom spreads here. There were some in there that looked interesting, but the premium looked too low. I don't think I would do it. So let's just buy 100. And at 47.29, what I really want to do on the fly, 48 at the money, 45. 40-cent net credit. I'm probably going to have about a 5% risk on this one with a 2.1% return. Nope, 4 and 2.4. Not quite the upside I wanted. Want a little bit more. 40 cents is a little bit better there. 70 to 27. Oh, it's 33 cents, excuse me. It was still a little bit better there. But 2.4 for 21 days, I need a little higher. And do I want to go out to 49 in this case to go further out of the money to have a lower probability? Or do I want to go to a lower put at 44? I don't think so, because that's going to take the risk outside of the bounds of that 4%. Going to the 49, 45 is only a 10-cent premium, so the return would be higher if it went to 49, but I don't think that's worth it for the smaller net premium. So for standard October, I'll try the 44 put, but I don't think I'm going to like it. Okay, so it's not just about having the right stock trend. Yeah, no, too high. Not close to what I'm looking for there, and too high of a risk. 6% of the risk, 2.7 max return with the 48-44 combination. They don't match my goals. This one for 21 days out. My goals aren't your goals. My trading plan is not your trading plan. So I'm probably not going to do that. Now, to follow up Rhajiv's question, he said, you know, Intel might be a better chart. I agree. I don't like the collar structure that I would use. Standard for this is a standard collar. It doesn't match my goals personally. Looks like a good trade. That 2.4 to 4, pretty good. Probably not going to get close to 1 to 1. As we saw, Paul's were a little bit closer. They were 1-point strike differences, which doesn't give you a lot of wiggle room. The original position was 1950 to 1850, but it doesn't give you a lot of wiggle room. So if I did a 48.47, I can't I? Because I want to have a positive premium. We're looking at 70-cent premium in, 80 cents out. So 2-point spread, 48.46, might be closer to that 1-to-1 ratio we were looking for, 2 to 2.3. But yeah, I don't know if that would suit my needs for a 21-day trade for my portfolio. That's my trading plan. You've got to evaluate it's yours. But okay, after all that, Rhajiv goes on in this case to say, you know, beyond the Intel idea. Okay, now he says, I'm sorry, so this one I don't think is a good long collar position at this time. If I'm more bullish, I might do it as a long-term radioactive trade. As I mentioned, I would look for something different in the stock chart. That's me personally. And I can't give direct trading advice, but those collars don't match my trading plan. That's really all I can say. The stock might come up in my search results. The collars available for October, standard expiration 21 days out, would not match my goals. Now, you go on to talk about CRON, Rhajiv, and you say how to create a bullish position for CRON. All right, now right away you say you create half a position by selling the 8-strike put. Okay, that's neutral to bullish, looking for premium. Okay, not really a bullish approach, but then you say, and then you bought the 13 call and sold the 16 call for 60-cent net credit in November. I don't see how this is bullish, but let's take a look. Okay, let's go back to custom spreads. Okay. Now, this strategy, you're doing a naked put with a bull call debit spread. You are double bullish, but you have 2 capped gains. It's not really upside bullish. Okay, you've got 2 capped gains on the position. So we sold the November series. This thing is standard expiration. You sold the 8 put, bought a 13 and sold a 16. Is that what you said? You don't have to, I'm sorry, you don't have to reply that. That means, oh, you sold the 16. Strike that, reverse it. You bought the 13, sold the 16. Sell, buy, sell. Bull call debit spread, 13 to 16, strike. As you tend to do, which I'm not a huge fan of, we've talked about this, you're speculating over a 3-month time frame that the stock's going to be above 16, or at least above the break even of 13.50. But you run the risk of stagnation or a decline where both of these options expire worthless and you lose that net debit. Now the total, you said you got a net credit of 60 cents. You must have done this a while ago. So I think you're saying the whole thing is, if I open this today, it's a wash. I have a 0 cost basis. Okay, I get that. You've got a 0 cost basis. You can't start losing money until the position drops below $8. Okay, you've got a naked put that you've got to put up the $800 margin requirement for because the bull call debit spread doesn't do it. Again, is there a better way to take advantage of a bullish position here? I don't know, because it depends on your expectations, Rhajiv. This is the trade you're looking at. Do I like the fact that between 13 and 8, the stock's between 13 and 8, you essentially can't lose any money? And you said you got a credit of 60. Maybe you entered this a couple of weeks ago and then you did this today after the stock had moved up so that you actually have a 60-cent net credit. So you're 60-cent profitable, which is pretty good here. You've got to put the $800 to buy the position. So even that looks like a decent return if you're not at the wash zone here between 13 and 8. Even if you are at the wash zone, it's highly unlikely you'll take a loss unless this stock completely collapses down to $6, $7. But remember, the risk is $800. Now, the profit looks exceptional if it's way up here. So you can say, well, Mike, I'm not going to take this loss, this huge loss, or this $300 loss unless the stock's down to 5. Yeah, but you're not going to see that $300 gain until the stock's up to 16. And the stock's at 11. So it drops 6 points down to 5, or it moves up 5 points to 16. Which has the better probability? It's about the same, okay, from where it is right now. You're talking about a 2-month period, roughly. I said 3 months, but you're talking about a 2-month period of time. So what's a better bullish trade? You know, I can't answer that because it has to depend on your outlook, and then of course it has to depend on what none of us know. You know, all these things I mentioned are what's worked for me in the past with technical indicators, what I've seen work, what has worked for me in my strategies, and what hasn't worked for me as well. And in that scenario, if the stock's up at 18, then you pick the right strategy. Could I get a bigger return than 37.5% in 2 months if the stock's at 18? If I buy an 11 call right now for $1, right, it'd be worth $7. That's a huge profit. Someone mentioned a ratio call spread. Okay, I could do a ratio call spread in that situation. Am I going to get into, Rhajiv, analysis of trying to say, oh, well, you could have bought a December 16 call, done the bull call debit spread for November, and in the meantime done another bull call or bull put credit spread out of the money for October? No, I'm sorry, I'm not going to do that. I'm not going to analyze throwing multiple legs into a strategy to see what is the best outcome, okay? I can help you with that by discussing things. You know, this strategy has a very high gain, but it's also a capped gain. Depending on what the stock does, we can look at it. I'll put down a note in my calendar. November 18th expiration. Evaluate CRON, what would have worked best. It doesn't really help you now. I understand that. But hindsight is always 20/20. This thing could go down to 5. It could go up to 18. It could do that by October. It could take all the way to November. It could stay exactly where it is for the next 2 months, and you're looking okay. Right? The great thing about options is that they give you options. The bad thing for an options educator is that options give you options. We could spend a full week analyzing different ratio combinations, diagonal ratio combinations, double diagonals, standard diagonals, collars, long collars, tweaks on long collars, and more to go over the pros and cons of each individual one. What comes out at the end of the day is not which strategy is best. Which strategy is the best for CRON? Which strategy is the best for Intel? Which strategy is the best for this? The answer to that question, Rhajiv, is you going into this custom spread tool just as I'm doing and writing out what your expectations are for CRON based on your technical analysis, where it's going to be, where you think it's going to be, where you think it might be. And it could be anywhere. We know that. But you got into this position, you're thinking about this position for a reason. That if the stock is as high as $18, $16, $17 in November, this gets you the return you want of 37%, 2 months away. Okay? Now graph out other strategies. Do they give you the same return with the same type of risk structure you're willing to take if the stock's at 17? Also take into account, are you comfortable with each position if the stock does drop down to $6 or $5? If it does drop $5 or move up $5, what's the best case scenario? And if it stays right where it is, take that into account too. Oh, sorry, folks. So this is a 60-day trade, roughly. A little bit more, 60, no, it's a little less, 45-day trade. My apologies. So in the next 45 days, strategies you're considering: diagonal calendar spread, standard bull call debit without the extra naked put, this position, straddle, long straddle, just a long call. Over time, if you assume that you're right 67, 70, let's just call it, % of the time with the strategies you're choosing and the stock direction you're choosing, what is the risk of the other strategies? What is the loss level you would take on the other strategies 30% of the time with the same type of, so if you're expecting a move of 5 points up, expect a move 5 points down, but if you only get that 30% of the time and you get this, even the max, 65, let's say, % of the time, and the other 5%, you're right in the middle for a wash. What gives you the best outcome mathematically? Work for a strategy plan, not what is the best strategy for this one stock. Think, what stocks do I want for a strategy? What strategy do I want that matches my risk-reward tolerance? And does that strategy get me to profitability long-term over time? And if it does get me to profitability long-term over time, are there a way I can increase that with a different strategy, assuming the same win-loss ratio? Now, the numbers I gave you might not be fair, but I'm saying in this speculative position, you have a credit here, you're going to make some money. The ratio back spreads are discussed where you can probably have a limited max profit, a spike, and then a loss, okay? But if it just stays here or moves down, you have some profit. The only way you lose money is if it really gaps up and then you have a peak up here, okay? Okay, I'm sorry, let me explain what I'm talking about there. It's not a strategy I necessarily trade, but instead of doing that, let's say we went to November, 49 days out in time it is actually, and bought one, sold two, okay? So if I'm not as aggressive as you, sorry there. This would help, wouldn't it? That was a bull call debit spread. So in this case here, I get a net credit of 43, not as high as you have, but it's all the way down to 0. I get a peak profit here of 243, not the 300 you had, but then I'm taking the risk to the upside. That's why I don't think a back ratio spread might be as good as you did. However, if it drops down to $3, $4, $5, you're taking a $300, $400, $500, $700 risk. This would still be profiting 43 cents. Flip a coin. How often are the stocks you're looking at going to drop the 5, 6, 7 points, almost 50%, where you'd have to worry about the loss in your trade, but how often are they actually moving up 50% to where you're seeing the maximum profit? Yeah, that's a question you have to answer for yourself based on your stock analysis and the success rate you've had with the criteria that you're using for those positions, okay? To help you out with that a little bit, just very briefly, Sam says that what he looks for is, oh shoot, I just lost it. I apologize. Okay, when he says, Sam says when he sees the 10-day EMA crossing the 20-day, then one has to pay attention to play the downside in that scenario. So that's, I'm not looking at the 10-day and 20-day EMA, but that's just what Sam's thoughts are. He's referring to AMD, the cross there came in at 32.33, so he feels that's more bearish. He also feels that, I'm sorry, Intel is sort of in that bearish zone potentially. And Sam says CRON has pulled back 3 days, but has moved up today. He's still holding CRON from $9, down from 15 to 11, and is in a downtrend. That's where Sam was going there. And right now, his personal aspect is that he's expecting it to be bearish in that situation based on his chart reading. So that's just his thoughts, not mine. Okay, Rhajiv, that's where he's saying there. So in that sense, think about your position there, where it stands. And then, of course, let's get back to where Rhajiv was going. All right, that's just analysis. And Rhajiv says if it keeps going up, you'll sell the put near the strike and buy puts 3 strikes down. Okay, so yeah, you're going to roll that in that situation. You saw it at the back spread too. But doing it with the puts, that's fine. Yeah, it's just another combination, selling 2 puts of 10 and buying the 11 put, but later discarded this. Yeah, and you'd get a similar risk return to what we're seeing here as well. Okay, so I can answer a lot of questions for you at any time. I can answer questions about different comparisons that you bring in the webinar. But as I mentioned here, and this is half, the return based on the risk in this position, I meant to point out, this is half of what you'd get with the strategy you have. I'm not saying the position you have open or the position you presented to me, Rhajiv, is a bad one. But run the scenarios. I can also say that, look, if I expected it to be up above 16 by November, naturally, I might just buy a call. If I expect it would recover, Sam's already chimed in with his thoughts. They're a little expensive, but no, I'm not going to buy a November call in that case, folks. I'm sorry, I'd buy a January call. I buy the January 11 that's priced at 260. Let's clear this out. Let's buy one. I'd probably be 265, 270. Oh, I cleared the wrong one. Let's do that again. My apologies, folks. January 11. I could go out of the money and speculate, but I'm just going to take the right at the money, 11 strike call, 265. There's a faster way to do this. I'm going to show you that in just one moment. All right, so what happens if the stock is at that $17 range we were talking about on November expiration, which was the 19th? Oh, no, it wasn't the 19th. Yeah, 16th. All right, so if the stock was at 17 there, we'd have a profit of $389. It's $89 higher than what you have there, and it's, you know, above 100% return on that scenario. Now, a quick way when you're doing your analysis, Rhajiv, if you say to yourself, okay, well, I've got this spread X that we just talked about, that naked put with the out-of-the-money bull call debit spread with high speculation on the maximum profit. And you said, well, which calls would be better if at November expiration I thought the stock would be at 17? Well, go to long call or long put, click on the long option finder, put in your values. And again, you know, Sam says it's bullish right now. I'm sorry, my apologies, Sam. Sam says it's bearish right now. I'll put in 17, and I'll say let's put in $1,000, or you were using lower risk, so I'm going to put in $750 as the capital invested, and let's go to November expiration, the 16th, correct? Yes. So on or around the 16th, I expect the CRON is going to be at 17. What this tool did in that instant is grabbed all of the available call options for CRON with all the different expirations, grabbed their current value, and what those options would be worth if the stock hit your target price on your target date. And of course, the one with the highest return is the 16. January 11 is in there. We're talking about 146, 150, 158. So in theory, the 16 would be the best based on the Black-Scholes pricing model of remaining time premium and intrinsic value if the stock was at 17 based on its current price of 135. Jim says, wait, where are the November series? Why am I only seeing January and April? It's because I selected the actual November expiration date. The system counts that those options would have been gone one way or the other. So let's put it to the 15th, one day before expiration. Now we'll see all the Novembers. The winner would be the November 12 at 153, return of 225%. Does that make sense? Yeah, it does. It's 153 to buy the 12 call right now. If on the 15th, CRON was at 17, it'd be worth $5. Okay, so you make a $3.47 profit. You can buy 4 contracts with that 750 estimate. So, you know, we put in 614 to get 1996 back. There's your 225%. Would be at $5. We're not saying it's going to be at 17, but if that's your speculation, you can use this tool quickly, Rhajiv, to see how would the long calls compare to your X strategy monetarily and percentage-wise if the stock did hit your expectations. What's the risk here? Well, if it drops to 5, or if it even stays the same price, I lose that entire 153 where you would have been making 60 cents. That's the trade-off you've got to look at for your position. The diagonal spread, you would have capped the upside gain. You would have had to roll that short call once or twice, depending on what you originally sold, but the long call would still be gaining and still have a lot of value, but some of that's going to be countered by the intrinsic value of the short option, your short call that you sold in the diagonal call spread if the stock continues up. Okay, so that's something to consider there. Just like we talked about with the collars and with covered calls, a diagonal is a capped gain that if it exceeds your expectations, you likely will have to manage it. With a covered call and a collar, you don't necessarily have to manage it. You can take the return. But at a diagonal, which I love, I trade myself, you know that, we've talked about that. But on a diagonal on CRON, and we're talking about November, so I'm going to go out January, and I'm going to sell short-term October 28th. Oh. Yeah, I'm going to sell October 28th. So I'm bullish, and I think it might be around 13 or 14, but I still need some good premium. So I'm going to go 13. And the call side here, I'm always going to go slightly in the money. I'm going to go to the 10 at 3. Okay. All right, so buy and sell. Now, I shorten the time frame because I'm not expecting that on November 16th, CRON is suddenly going to be trading at 17. Sam, I know what you're saying. You're saying that you feel that this is bearish, that the other marijuana stocks or the other stocks in this industry are going higher and are dropping. They're like Bitcoins in the way that they're moving a little bit. And that you have to understand that this is pure speculation on this industry. Absolutely. Tilray killed a lot of people. Tilray profited a lot of people. These aren't like Apple or Square or Facebook, sort of Facebook, but as Sam mentioned, these aren't stocks that are just gradually moving up. They're flipping up and down the whole time. That's a very important point Sam brings up. Why? Because just like we saw with that collar management at the beginning of the discussion, even if you're in that trade, Rhajiv, that we looked at for you, now let's go to our diagonal here, but even if you're in the trade that you mentioned, if CRON pulls down to 9, you're going to be concerned about that 8 put, and you're going to consider managing it. Okay, so you manage it, but then the stock comes back up. You would have been better leaving it alone. You say, okay, now my bull call is doing well, but then it comes back down. Now you think, oh, I got to manage this bull call and this other naked put I did. So you make another management, and then the stock comes back up. Just like we saw with the collar, too much management can take out too much profit of a position that you expected to have, and that can be very dangerous. So why do I bring this up? Well, the diagonal here, I mentioned that I would be selling maybe the 13 because I went to October expiration, not standard November. I'm basing that on your position that you had. The max profit you were looking for would match if your expectation was that CRON could hit 17 on November expiration. Here I'm saying that, well, in order to hit the 17, it's got to go somewhere first. It's got to go to 13 or 15. But those two strikes, 14, 15, and 16, didn't have enough premium for the shorter term trade. So I had to go to the 13, knowing full well that when the stock gets near 13, near October expiration, I'm going to move this up to the 15 or maybe the 16 strike, still holding this January 10 call, which is increasing in value. But again, you've capped the gain. This is where we could talk about option number 2. Instead of the diagonal spread, one thing you might want to, but look at the return. The return is $184 compared to the $300 that you had, and the $300 and some we saw for the long option there. And there's a very interesting point that was just mentioned. Yeah, holding the stock can kill you in one day. I was reading something Sam said, but that's not what I thought. There's another process, another thought that comes to mind. All right, so here we are in this one. What if now instead I take some of that 78-cent premium for the October 26, 28 days out? Wow, look at that. Bid-ask spread on the 17 strike, 15 to 60. That is not favorable at all for any kind of management, whether you're buying or selling, but I'm going to buy it. Okay, so what am I doing? I'm taking a diagonal calendar spread, but I'm buying an out-of-the-money call, sort of like a bear call spread on top of a stock, but a bear call spread here. Interesting, but now check out, the risk is still high. All right, the risk's still at 264. We have an infinite upside, but that's really if it only goes up to 16, 17, 18, 19. And here's another thought. Sam commented in these cases, and he referenced SYN again, that it opened at 360, was up to 780, and closed at 260. That's not a stock to hold. It's also a stock that would be difficult to swing trade with options on a consistent basis because the volatilities are so high in these industries. And Sam, you've experienced this with Tilray. This is why Ernie and I did not get into Tilray. Yeah, maybe we missed the boat. That's okay, because the implied volatilities of trying to move these positions back and forth and forward and backwards are going to kill you. 100% implied volatility. Anytime these stocks fluctuate and move, you say, look at the premium I'm getting for selling this. Look at the premium you're paying to buy something back. You know, as these things fluctuates, this could go much higher than 105 if it declines in price, has a sudden gap down next week where you're looking to roll, but now the implied volatility is killing you. And then you say, oh, well, I'm selling into the high implied volatility too. Right. But then if it keeps moving up and down and up and down, you're managing a position by paying into just as high a implied volatility as you're trying to sell into. And that's when it gets tricky. Oh, yeah, that's the danger. I don't know if these stocks are going to do that. Sam, you might have a better feel for it. Sam mentioned that his SYN example related to this. They stopped trading SYN at one point. It was sort of delisted. It halted trading at one point. And you know, whenever it comes out of that, that if you're in a legged position that's directional, you just better hope that it goes in your direction. Oh, I didn't know that. Tilray was stopped 5 times in one day. I did not know that they had stopped when it hit 300. Okay, I did not know that. Doesn't surprise me by any stretch of the imagination. But yeah, I didn't realize that it was stopped. I wasn't watching it that frequently that day when it got up to the 300. But any case, that's just another thought here with these kind of strategies. Playing the hot market, for lack of a better term, playing the hot sector. Sam mentioned Bitcoin. This was the talk of, this was the talk of the email. I got to be honest. I mean, Sam had mentioned this, and he had mentioned CGC sometime back in August, I believe it was, or probably even early September in this time frame. There's that spike up to 300. You know, it doubled, opened at 150, went to 300. Well, the day before closes at 150. It opened at about 290, went up to 300, and then it came back down and closed there at 210, right? That was in one day, and that's when it was halted 5 times, okay? But yeah, people were saying here at 150 and 160, and then said, oh, well, you know, why didn't it come up in my search screen? Why didn't it come up in my search results? Well, the volatility at this point was already high, meaning that it might have had return you would have wanted for a covered call or a naked put or something along those lines. But a bull put didn't really make sense, did it? No, it didn't. Implied volatility was too high. You're paying too much in and getting less out. It wasn't as high as a return, actually, as normal positions that are showing a normal trade, because you're buying just to as much high implied volatility as you're selling it. Okay, yeah, Sam, you were in it and you could not sell it at all. Yeah, Sam was in this stock, I believe, at this point, is what he's saying, and he couldn't sell it at all. Couldn't get out of it at any time until he made profit on it. We know because he phoned in from Australia last week saying that the calls on Tilray, and I believe it was Apple or was it Facebook, that paid for your trip there. And that's fine. That's great. That's fantastic. You got the good trade better than I did. But where are we now? You're right at square one almost in this case. And if you'd bought a call here and couldn't get out of it, you might have actually lost money at this point because the implied volatility would have spiked and then come back down. And it was going up here. It's probably still pretty good. So, I mean, that's just kind of the gamble. But following the hot sector, following the hot thing with options is when you really have to pay attention to implied volatility, and not so much as the concept of getting into the position and how is implied volatility favoring you or hurting you if it is, but not so much how much is it favoring you. If the implied volatility stays in that range, how much is it hurting you if you have to manage it going forward? All that being said, Rhajiv, if you did get a 60-cent credit for that 3 transaction where you would make a 60-cent profit between 13 and 8, I believe it was, and then the maximum profits realized above 16, as long as the stock doesn't really drop below 740, that's a reasonable trade, like a ratio back spread that has low risk in that wide range and a potential profit in that wide range, and the potential for more profit if you're right. But it is in a bearish trend. And then as SYN, as Sam keeps mentioning, obviously went from 760 to 260. If that happens on CRON, you're at the maximum loss for the trade, and it was completely not worth it, right? It wasn't worth it at all. I'm sitting here babbling about it. Let's just take a look ourselves. Let's go to like a 1 week or maybe just we'll keep it at 1 month. How about that? It's just so weird. Omex does this to me. It's a stock I love. Yeah, okay, so weird. Very, very weird. Oh, I'm sorry, Sam. I misunderstood you. I thought you were saying you got out earlier, as in earlier the past few weeks you got out at 7 and has been declining and closed at 260. This was all in one day. I am sorry. But yeah, hard to do something with that. The stock I was referring to, I keep a few hundred shares of this in my portfolio. I was going to ask a poll. I think I'm the only person that does this. Go back to 3 years. This was the first stock I ever bought when it was at 520. That was back in 2002, 2003. Different symbol at that point. Let me go back 10 years. Let's see if we can go back 1 decade, yeah. So this is the very first stock I bought. Bought 50 or 60 shares. You know, it's been all over the place. There's been some splits, big decline here. I bought this stock in this range. It was older than that. I think it had it had another dip here. That's right, it had another dip here. I bought it back here when it was around this $8, $9, $10 range. Yes, it wrote it up to 60. How? Anyone know what OMEX is? I actually can't see it because I removed it. Odyssey Marine Exploration. They're treasure hunters. These are the guys that found that huge Spanish galleon a few years back off of Gibraltar, and in the middle of the night put all of the gold they found on the ship into plastic containers. I think they were empty kitty litter containers, hundreds of them if I'm not mistaken, and flew them back to Florida without telling the Spanish government, without telling the U.S. that they were flying in with what cargo. They just landed back to, you know, their home base sort of, but, you know, at the airstrip there near Florida. Well, yeah, Spain got that money back. They broke a law and tried to hide it, and then I think they were going to try to say, they didn't go bankrupt though. But that was in this time frame. This was a different one. This was a different ship they found, and it went up to 60. Comes back down by a few more hundred shares. This is where they found the Spanish galleon off of Gibraltar. This is where they started having legal troubles. They found another ship here, but then the legal troubles really kicked in. Okay, so it just dropped. So yeah, sorry, no one needs to really know this, but I like just buying 50 shares, 100 shares, selling 50 shares, selling 100 shares. I don't trade, it has options. I just don't trade options on it anymore. This is pure sentiment because it's my first stock. So I just trade with it, and then you can see as we looked in the last 1 year, the same thing. Great news jumps up to this actually I think was a reversal, but then they had great news and earnings that surprised, and then they came back to the $8 range. But yeah, I picked up more shares in this $3 range too. I don't know why I do it. It's just fun. It's play money in a sense, and it's sentimental. It's the very first stock I bought, so I just play it, and then eventually they find something, get good news. If they find another treasure ship, they'll probably go up to 25, and then they'll come right back down to 6 a month later. Not a lot of value in the stock, but it's fun to play. It's like day trading. It is day trading. It's like swing trading, but no more than 100 shares, 150 shares ever at a time. So just follow that. I just think it's fun, but that's the wild ride. It's been all over the map. To tell you the truth, that one jump it had from about $10 to about $45, $50 in the first shipwreck they found, that's what actually pushed me out of covered calls, just doing covered calls in my portfolio, to start doing collars and other strategies, because I'd only started trading with about $4,000 at the time. That was a third of my investment portfolio, which means my investment portfolio almost tripled. You know, start out with $4,000. That, you know, it's roughly $1,000, $1,200 I had in that stock. When it pushed up to 45 and 50, oh, that was worth a lot of money. So I increased it on that, and then that actually expanded my ability to jump into diagonals because I had more funds and I had more trades, and I could now apply to make more trades and things of that nature. Higher level of options trading. That was back with Options Express, I believe, in 2003, 2004. So anyway, I just like to point that out, that these are the hot stocks and the hot days and the hot sectors can come back to bite you if you mistime them. They can bite you if you continually to try to manage them based on every little movement going forward. Okay. So that's just, and Sam's commenting on some of that, and that's exactly right. You know, you're trying to move with the market and catch the technicals that you feel work best and satisfy the needs best, but eventually, sometimes it's best not to manage. Try not to get a higher return. Take the return that matched your trading plan and move on. Find a new trade. Don't try to keep chasing this one by only increasing your return by 1 or 2% if your goal is to make 3 or 4%. Okay. Now, Rhajiv does a follow-up on my statement in a sense. He says, Mike, I did a few diagonal trades with some tweaks and Worked out 3 times out of 3. Selling the front week before earnings and buying later week after. Okay, BAC was 1, 30.5 call, 20-cent net credit. Did that with Facebook too, closed yesterday for a strong profit. Okay, yeah, it's you're using a calendar spread to straddle an earnings event. And the hope is that the premium that you get decays without the increase of implied volatility. The stock doesn't go above that short strike that you sold, and then you have the long call at a much reduced cost basis heading into earnings. You can use the profit you took from the short call to buy a put and be in a straddle position. It's not a bad play, although sometimes it's difficult because your 3 out of 3 works. That's great. And you mentioned BAC, a slow mover, right? You mentioned Facebook, a gradual mover. Real quick, I'm going to tell you about a trade, probably my most successful trade this week, actually. And, well, that's not entirely accurate, but it's pretty close. The most successful trade I had this week was on Goose. Ignore that 57 a call that expired. I haven't updated this portfolio. I just want to go to the stock chart here. Here we go. So I'm in Goose with a stock cost basis of, I don't know what it is, 50, 51 or something after I had to roll up the call that I had sold before that giant movement. And I think I'm holding a 55 put in this situation. And I had a call expire here and I think here. All right, I sold the 60 call here and here. I either rolled this one and then had this one expire, so it was looking good. Well, the stock was down here in this range again, and I'm thinking on Thursday, you know what? I'm sorry, Tuesday. I'm thinking on Tuesday, you know what? I've only got till October left with this put. I should sell some more premium here. The stock's at 58.97. I should sell the 60 call for 2 weeks out or 1 week out. Get another 60, 70 cents. It'll lower the cost basis, and I'll still have a good double-digit return potential on the position. I didn't. Very next day, it goes up to 64 out of the blue. And then here it's 65, closing it, just dropped back down again today on that position. My best trade today was not selling a call. My best trade this week, not selling a call. Would it have lowered my risk? Yes. Would it have generated income to lower the cost basis? Yes. Would have it increased my return if the stock happened to be right at 60 1 week or 2 week out? Yes. Would it have gone against what the stock did? Yes, but I didn't know that at the time. So that was my best trade, was doing nothing. A lot of times, the best decision you could make and the best trade you could make as the stock is fluctuating is do nothing. I was waiting for someone to say that. Someone said, well, a lot of times the worst thing you can do is do nothing. That's absolutely true too. If you've put yourself up to too much exposure, too much risk in one position, and a stock starts to swing against you and move quickly or move violently, the worst thing you can do is do nothing. But if I'm already in a protected married put position where I have a very small risk on the trade and I sold a call and had a potential double-digit profit, and worst case scenario is it goes up and I only make 4%, I would hate that. But again, it's still a winning trade. I'm okay doing nothing here. So now I can probably sell the 65. We'll see what happens Monday. It could go up to 67. I haven't sold the 65 yet, but I'm going to see what happens Monday. Could open at 61. Well, then I just sell the 62.5. I'll wait and see what it's looking like in that case. But I just wanted to bring that up, that sometimes the best, when it creeps in your head, the best thing you can do is do nothing. For me, best trade of the week was on Goose and doing nothing. Didn't sell the call. Did I know it was going to move that amount? No. Did I have any inkling other than the MACD looked like it was on a move a little bit and it was getting above that 20-day moving average? No. Should I check the 20-day and 10-day EMA as Sam mentioned and see what happened on that day to verify that I would have been able to see that it was going to jump based on that? Probably should. I learn something from you guys every week, so I should check that out and see if I should start using that a little bit more on this particular stock. But again, that just goes back to the discussion of trading plan and adjustments, not rolling for the sake of rolling, not feeling forced to make an adjustment on a longer term play, focusing on getting the strategy that matches your risk reward in the portfolio, the structure that matches your risk reward and meets your goals, as opposed to saying, what is the best strategy on Goose today? What is the best strategy on CRON today? Focus on the strategy that matches your goal. Now, Rhajiv, you're doing the right thing. You presented me with a trade. We talked about your trade, and you talked about other ideas, and we showed a couple of them. But it's really up to you to jump in there and say, based on what you think is possible with CRON, best and worst case scenarios, long term, if you open 10 positions with a similar risk-reward profile, and you are right 60% of the time, wrong 30% of the time, and 5 or 10% you made a little bit or lost a little bit, which structure would work best for you out of 100 trades? That's something to consider. That's why we always talk about that trade simulator tool at Radioactive Trading, to run those scenarios to see the potential outcomes of a trading plan, as opposed to, I think X, this stock is hot in the news, I think X, what is the best strategy? That's not a long-term benefit to your portfolio. It's a lottery ticket playing a hot name, hot stock, hot sector. Okay? Sam swings in and out of these positions based on his technicals, and he's been extraordinarily successful. Swing trading with stock and with options, in a sense. Also long-term playing, because a lot of times when he owns the stock for more than 3 or 4 months, he's got a put on it that he can't lose more than 4 or 5% of his total capital invested in that stock, and he's generating profits around that structure as well. Similar to what we do in radioactive trading, but he's much more active. It's a different approach slightly. And that's good. And sometimes he does trade option plays, as I do as well, because it matches his trading plan, because he focuses on the risk and he makes sure that any position he enters, even in the worst case scenario, that it's not going to take out more than a few percent of his total portfolio value. Okay. It's a thought, Sam. Sam just commented a very complicated thing to me. I don't want to say it's complicated, but he's projecting forward. He says, what if you sold the stock at 67, which I probably should have done 3 months ago, and buy a straddle at 70, and ride it down to 51, and buy stocks of Goose again? Not a bad idea. Okay. I just got to look to see what's happening. I think this would probably go back up to 67, 68, 69. We're going to see. I might just close the whole Mary put at this point if it goes up near 70, by the way, because I've more than exceeded my expectations with this particular trade. And well, okay. Oh, I see. Okay, you're going further back in time. You're looking at your chart while I'm speaking, and you're talking about when that large gap happened. What if you had sold at 67 here at the peak, done a straddle, allowed it to go back down here at 51, bought the stock back? And my charts, kind of showed that too. But I would have probably sold here. I should have sold here. I could have sold there. But I kept trading the position. And I traded it down to here. I was selling calls during this downtrend back down to 51. Sold one call up here as I showed you, but I waited here to when it was at 60. When I thought it was going to breach it, I rolled it to the 60 here, and that ended up expiring, and didn't sell the call again on that position. Okay, and they said now it's filling that gap again, moving up. Yeah, I see that. Yeah, and I'm very happy with it. And like I said, as we talked about earlier with Intel, I believe it was, if I ran a search today for a married put or a collar, I know Goose would come up. Why? 20-day Bollinger Band, increasing RSI, even though it's flattened a little bit. Positive MACD broken above the positive and just above the divergence line within the last 3 days. So that's what I'm looking at there. Yeah, so it's been a good mover, and it's had a lot of opportunities to do different income methods. And Rhajiv says it may be due to a seasonal thing that it ramped up. Yeah, its biggest gain was in the summer, and that was because of earnings. That huge gap we saw was because of earnings, but that was in summer with winter apparel. So yeah, they need to be gearing up for a lot of things coming up. They need to be gearing up for the different things also in that regards. Mark, I am not going to have the time. I do apologize. It's at 5:53 p.m. Eastern Time. I usually allow to go to 6 in this case, but usually I can't start a new topic at 5:55 p.m. Mark says, can you talk about straddles and time decay and your point of view on these? I'm gonna tell you this, Mark, and I'll take your comment here. You do them as scalping devices, 90 days to expiration, and keep the trade on only a few days. Okay. Well, that's tough depending on what happens in those few days, I understand. I think you have, Mark. I'm almost positive you have. But if you haven't yet, I'll give you the link here. Let me add the long straddles. Oh, no, sorry. Let me just go to the long straddle page, not the search, the long straddle page. This is Ernie. Ernie did a recent video. So it says part 1 of 3. He's working on part 2 right now. But this, can I go right to the link? Yeah, there we go. Let me just copy that. Don't autoplay. Send it to you in the chat window. So this link here is Ernie's introduction to a straddle approach that he's using now, using very short term, different than what you're doing. I know you're using 90 days to expiration. But what he's doing here is looking at shorter term straddles around earnings, knowing that you're going to experience a large volatility crush in time decay, but the structure that he's been using that's been working out for him to be profitable with that approach straddles around earnings. And that situation is powerop.com/longstraddlevideo.asp. And I sent that to everyone in the chat window there, but I'll put something up there in the archive as well for this. So that's one thing to consider. Now, another thing here is that we have an older, oh no, good, we removed it based on my feedback. We had an older article in here, and I think it's in our blog actually for the straddles and strangles, which talks about those longer term 60 to 90 day out straddles and strangles. And the time decay, the one thing I'm going to suggest to you as a starting point, and send me an email later with other questions that you might have. But the one thing I would suggest to you when looking at straddles or strangles, when you're opening, even if you're 90 days out in time, make sure that you're looking for a call and put implied volatility range of less than 50. Okay, start in the lower range of their implied volatility. Okay, I don't want to buy a call right now that's in the 80th percentile. Even if it has 90 days to expiration, it's only been open for 15 days. I don't want to buy something that's in the 90 percentile, 80 percentile, or 70 percentile of its implied volatility range that has been released on the market, because if it goes back to the norm, I can lose money on that call and the put without the stock even moving. You know, suffering a, lack of a better term, premature volatility crush because I bought in when the volatility was at a peak. Okay? So that filter might help you in that scenario. And I don't know if you'll find them right now, it'll be difficult, but looking for the IVHV, the implied volatility of the option divided by the historical volatility of the stock, looking for that to be less than 1. You're probably going to have problems with that right now because I think the implied volatilities on average across the market, all calls and puts, is twice, almost 3 times the average 50-day stock volatility on all optionable stocks. Last time I checked, the average implied volatility was around 0.7. The average 50-day stock volatility was around 0.28. Okay? Do you buy a strangle or straddle when the volatility is low and the VIX is low on SPY? In theory, yes. But if your expectation, now, so let me put it to you this way. In theory, yes, but if your expectation, no matter where SPY is right now, if it's at a high or if it's at a low, your expectation is it's going to continue to move up for the next 2 months or it's going to continue to move down, a strangle is not a bad play, even if volatility is high. What I would never do, well, I might, but what I would probably never do is if we have another VIX spike like we had back on February 9th to February 5th to February 9th, where the volatility spiked up to 26 or whatever it was, from 12 in a day, I don't think I'd be buying a straddle or strangle even if it was 60 to 90 days out at that time. I'm going to wait for things to start settling back down for the volatility to come back a little bit. Okay? It still would have been profitable for you. A straddle buying at the end of February 9th after things had gone its full run and it started to calm down, even though volatility was high, a 60-day to 70-day out straddle would have still been profitable, but not in the range you're expecting. It would have been 20% instead of maybe 100%, maybe 15% because we overpaid for the position. So I wouldn't do it right after a volatility spike in that situation. Oh, I didn't submit these. These are not going to show up when I submit them. because of this factor that I mentioned, that the average IVs right now, although you think you said VIX is low, it's at 12.12, but the implied volatility of a lot of options, even 30, 60, 90 days out, on average are higher than the historical volatility. They look overvalued. So that's something to consider. So those are some of the basic points that I'd consider. If you're using that search to find straddles and strangles, look for that call and put percent implied volatility range to be under 50%. You might even try under 40%. Don't be surprised if you're filtering out a lot of results, though. And we'll see how that pans out, though, in the weeks going forward, and earnings comes up as well. All right, well, and by earnings coming up, I mean in the next few weeks, next month, or when we enter the next cycle in the next several weeks, start to get at the last cycle there. All right, so, okay. There we go. Just wanted to remind everyone that today's material and my thoughts on your questions, my thoughts on the comments that were brought in by others based on your questions, and the discussion at hand designed for educational purposes, increasing investing performance, and options knowledge. Now, any stocks or options discussed today should not be taken as direct trading suggestions or advice. Options do involve risk, as we saw with some of the structures we created today, and they may not be suitable for all investors. If you'd like some of the tools that you saw today, the search tool we took a brief look at there, and if my apologies, with the long option finder to find the best long calls based on your criteria, and of course some of the other structures and tools that we saw as well. Well, you can test those out, plus all the other tools, for free for 14 days. Just go to PowerOp.com, put in your name and email address, start my trial now, and you have access to Power Options for 14 days. Our subscription levels after that trial start at $40 per month. They do go up as high as $120 for the real-time service, or real-time service plus the historical tools as well, but we also offer discounts for annualized subscriptions. You want to check out some other free information in addition to that video we sent out in the chat link, powerop.com/longstraddlevideo.asp. You can always go to the blog.powerop.com. And as mentioned, you can check out our webinars page at any time. It's just powerop.com/webinars.asp. And you can find us on YouTube. Most of the videos I record are, of course, thrown right up there on YouTube as a public video as well. And of course, remember, send me an email anytime. You can reach me at support@powerop.com or support@radioactivetrading.com. And of course, you can always feel free to call us during market hours at 302-992-7971. Of course, there's contact links at the bottom of every Power Options page. Sam, thank you as well for your comments and sharing with us, and thank you for your comments with Rhajiv, and as well as Sam also mentions that he's learned so much, also has learned so much from Rhajiv and CRON and Mark and others that have chimed in with us over the past past several weeks as well. And Sam says he hopes everyone has a fantastic weekend and gets time to relax and enjoy. Todd says, great session. Thank you, Todd. I'm glad you enjoyed it. I hope you got some useful educational information today. As always, today's presentation was recorded. It'll take some time to convert, and once it gets converted, I hope to try to get it up for you guys Saturday afternoon. You'll receive an email when this webinar is put up there on YouTube. I'll send you an email personally letting you know that's up on YouTube and on our webinars page, so you'll have time this weekend to access, digest some of this information, and move forward as well. And we'll, of course, be back next week with a couple live webinars during the week on Tuesday and Wednesday. We'll also be back, as always, Friday at 4:30 p.m. Eastern Time. Ladies and gentlemen, take care. Have a great weekend. We'll see you soon. Good night.